welcome to the Bloomberg Intelligence Industrial Analyst Call. Today is Thursday, December 14th, and it's 11 a.m. in New York. I'm your host, Christina Fury.
And I'm Chris Cellino. I cover U.S. machinery.
I'm Karen Ubelhart. I do the U.S. large cap industrials.
Mustafa Okur, I cover electrical equipment.
As we close out the year, we're going to discuss our 2024 outlook for all things industrial. Let's start off across the room with everyone. Can you give me your top three things you're looking out for your sectors next year? Chris, you can start.
Sure, I'll jump in here. Thanks. I'd say we are increasingly cautious heading into 2024 as U.S. machinery earnings are poised to decline after a really record 2023 performance. In aggregate, I think consensus expects machinery sales and earnings to be, relatively flat to down slightly next year. We think there's probably some downside risk there as some of these cyclical headwinds continue to intensify, which we think will drive lower volume really across all machinery verticals. We think we kind of hit this synchronous peak in both the ag, construction, and commercial vehicle markets in 23, and a slowing economy, declining orders, and rising inventories are going to put downward pressure on earnings next year. That being said, we believe this downturn will be somewhat mild versus some of the prior cycles that we've seen. Underlying fundamentals generally are healthy across the board for all machinery markets, just when you look at that relative to prior downturns. So what are we watching? Three things I'd say. One, order trends. We expect them to, broadly soften in 2024 as the economy begins to moderate here. I would also say, in addition to the orders, would also be looking to hear some commentary or looking for any insight on cancellations or deferrals. That would be a cautionary sign and an early indicator that things are deteriorating faster than maybe we would have anticipated. Number two, inventory levels. Especially early on in the year and coming at it or exiting 23, both new and used inventory continue to rise. Most companies are targeting production in line with retail demand next year. That may prove challenging if we continue to see this kind of continuation of trend of really universally higher inventories, again, both on the new and used side. So that would be another item to watch. And then third, I'd say decremental margins. There's certainly going to be a greater focus on the cost side of the equation in 24. We've already seen some companies announce, restructuring and additional cost actions, CNH being one recently. You also have input costs coming down. We actually have seen some structural margin improvements really across a number of my companies, especially with the new generations of products coming out that contain greater technology and content. So we would expect decrementals to hold up a little bit better in this downturn versus prior cycles, especially if we have this, modestly lower volume environment. If we see a more protracted downturn, then obviously that kind of goes out the window.
Thanks, Mustafa. What are the three key things that you're watching out for next year?
Sure. So on the electrical equipment side, we have this tug of war between underlying structural trends, which are quite positive. You have things like electrification driven by federal spending. You have very large projects driven by nearshoring. And then you have the adoption of AI and the investments that come with that from the data center side, driving demand for infrastructure companies like Vertiv, Eaton, and so on. And then on the other side, you have very weak demand due to destocking, especially on short cycle and discrete automation companies. And there is still weak consumer demand, so consumer related end markets. Residential construction is quite weak, and that is a function of high interest rates, which may persist into next year. All in all, I think we're looking at sort of high single-digit sales growth and potentially double-digit earnings growth for big electrical companies that are exposed to the sort of positive trends. They have very large backlogs. There are some signs of peaking backlogs. and in some cases, again, for the automation side, decreasing backlogs as soon as last quarter. But um, the more US exposed companies like Eaton, for example, Hubble, they should still see good earnings growth next year. Um, Europe is a watch point for us. Industrial production went down more than 6% in the last reading, and orders from the old continent actually fell for even for Eaton. So that is the main watch point for us, and the destocking, of course, that I mentioned before. And on top of that, there is some risk from consumer spreading into end markets like automotive, um, and um, and other consumer-related end markets.
Okay, I'll echo a few of the comments. I expect slower organic growth, although most markets we will see positive organic growth. Moderated pricing, but again, pricing should stay positive. I would also echo that a milder impact from the slowdown than in the past. And in the case of the large caps, some of it is mix change. There's more recurring revenue. There's more software. There's more stable mix than they've had in prior downturns. The cost reduction's been very aggressive, and pricing, while moderating, will still be positive. So you will see slower growth trends, but I think margins might be the part of the positive story this year. It really depends on where you're participating, whether it's going to be a great year or a not so great year, and if you in aerospace, obviously, that's the sector that's the strongest, and it continues to exceed expectations. And we're still growing up over 20% against 20% a year ago. So the momentum on the commercial aerospace side is not showing signs of slowing. There'll be some mix shifts next year because the OEM side will come up more and the margins are lower there. But I still think you're going to see very good performance out of anyone with aerospace exposure. Construction, another very large market for my group, is mixed, with the interest rates causing some of the traditional construction markets to soften. Residential's been soft for 2 years. Some pockets of commercial construction will also be negative, but we should see a ramp up in more of the federal dollars, and the private mega projects will be ramping up as well. The infrastructure bill has supported strong demand already, but the IRA bill should start to show more favorable volumes as all the bureaucracy gets in place and the projects start to flow. And then the short cycle demand will remain weak. And you can see that in orders like Parker Hannifin's orders in all their in their total industrial business, both U.S. and international, are negative, and other companies are commenting on short cycle being weak. And housing, consumer, and electronics are three of the areas that were already mentioned and that companies are focusing on. Most on the destocking side think we're pretty close to the end of that. That was an issue, particularly in HVAC, and most of the companies think that we're almost through clearing that out. So they'll be able to build more to end market demand next year.
Okay, and thank you everyone for those insights. Before we get too far into looking out into 2024, let's kind of review 2023 on a valuation perspective. How were your industries and sectors performing relative to S&P? Do you think there might be a reversal or a change next year in their valuations?
Yeah, I'll jump in here. I think obviously we saw multiples compress throughout the year. Machinery companies obviously deeply cyclical. They trade at north of a 40% discount to the S&P. Obviously, as some of these cyclical concerns have built throughout the year. You also have we've seen backlogs peak, orders decline, inventories are rising. So and obviously against a slowing economy that has intensified some of the concerns around a downturn next year. On average, the group trades at roughly 10.5 times next year's earnings. That's down from roughly 15 times earlier in the year, but we're slightly above the trough there. If you kind of unpack some of that, ag maybe slightly a slight premium to the rest of the group. 11 times on average. Construction just beneath that at 10 times, and then trucks. 7.5 times on average next year's earnings, next year's consensus earnings. So that's kind of the decomposition there. You know, the backdrop is not particularly favorable, just given that we are coming off peak for all these markets. So I'm not anticipating, significant moves one way or the other. We're trading, essentially near peak type earnings. So um, that's kind of where the machinery valuations stand today.
I'll go next. So for the market cap weighted S&P 500 electrical equipment index, you have Eaton, Emerson, Ametek, Rockwell, Hubbell, and Generac. I mean, that is market cap weighted, so Eaton is a big component of that. And relative premium to the market is very near its 5-year average. So 15% is the 5-year average, trading around 18% as of the first week of December when we put our outlook out. I think that is a vote of confidence that the backlogs will get executed, and as Karen mentioned, the federal dollars will sort of fill the gaps that will arise from tough comps and slowing economy. That does mean there is a risk of, we're in a prolonged growth cycle and higher interest rate environment, and that is not reflected in the average multiples. What was the other thing that I was going to say? Oh, the quality of the earnings beats that powers these multiples. In Q1, we started the year very strong. If you remember, both earnings growth and order growth was very, very robust, right? So we had record sales, but on top of that, even higher order growth. So that did power multiples early on in the year. But then as we progress throughout the year, the quality of the beats begin to deteriorate. And as of 3Q, a lot of the beats in my space were driven by pricing and margins as opposed to sales growth. And that was, that coupled with, either slowing or falling orders, it sets up sort of a risky environment for the premiums of these companies. But we'll see where things land. But the quality of the earnings beat in 4Q, as well as the guidance, will be quite important for the multiples.
I agree. It'll be really interesting to see how cautious companies come out with their initial guidance, which we'll get from everybody in the fourth quarter. I'd expect them to come out of the gate, kind of cautious on next year, and then we'll see what happens in the second half. In terms of premium for the large cap industrials, they're running at a very slight premium to the S&P 400, and the historical on an EV to EBITDA basis is a 13% premium, and on a PE basis is 11% premium. So they are below their 5-year average, and some of that is, it is concern about where we're going in the cycle. And of course, the cyclicals are the more cyclicals are at a deeper discount. And as long as there's recession fears, I don't really expect that premium to jump a whole lot in the near term, or revert to the mean, at least in the first half of this year.
Actually, I should add, Rockwell did come out with their annual guidance because they're a September year end, and on the low end for organic growth, I think they had -2%, so signaling a potential demand. In the call, when they were asked about this, the CEO did downplay it a little bit. He said, that means not only we don't get order growth, but we also have some cancellations in the backlog. So they are, as you said, Karen, maybe overly cautious since there is some uncertainty with the economy, with the destocking that we've seen so far.
And Deere's also been out with 2024 outlook. They're obviously different fiscal year, but we think their outlook was pretty cautious and probably overly conservative. They're anticipating large ag volumes down 10 to 15% next year, which I think was well ahead of what most investors had anticipated.
I would say the one exception to sort of the general commentary is Emerson also has a September year end. They put out their next year, and they actually have fairly decent organic growth expectations, sort of mid to about mid single digit, and in the first quarter actually higher than that. They have a lot of late cycle process controls in their portfolio, and the backlog there is at a record, and they're not really seeing signs of slowing on that. They are seeing slowdown on the discrete side, as Rockwell mentioned, but that's a smaller part of their business at this point. So they came out with, it was kind of an in line. It wasn't that it was better than people expected, but it's better than I expect a lot of companies to come out with, and it's the nature of the mix of their business.
Great. So I know a big theme this whole year, and you've all mentioned it, has been inventory and backlogs. Um, could you give me a view on if you think it's going to all, settle out finally in 2024 and reverse, and maybe also which subsectors are the most at risk with still bloated inventory issues?
I don't see a big reversal of trends unless we start seeing some significant production cuts. I think the area that we've seen the highest inventories continues to be on the small ag side. Those have probably peaked, and we are coming down, but that's probably the one exception. I think if you look across the other machinery markets and even large ag, again, both on the new and used side, inventories continue to rise at a pretty healthy clip. We're coming off kind of historically low levels, but we're rapidly approaching the 10, 15-year averages for inventories. So I'd expect them to continue to rise unless we start seeing more significant actions on the production side.
I mentioned earlier that there was, I'd say HVAC had probably the biggest inventory issue in my group, and that seems to be clearing out. Most of the companies think they'll pretty much be done with the inventory overhang in the channel by the end of this year. So I don't think that's going to be a big issue in general for the companies that I cover next year.
For me, short cycle automation, I guess, is the worst spot. In particular, Cognex has been suffering, which they provide machine vision solutions. I guess the least problematic section would be transformers, which Eaton makes. They're still in short supply, so you'd still probably wait 9 to 12 months to get your transformers. So it really depends on where you are in the coverage, but the general anecdotal evidence is sort of the first half of 2024, the big destocking will end. In fact, the CEO of Dover, which is a small multi-industrial with many end market exposure, they did say that in some parts of their business, the inventory levels are running below where they should be. It's just the cost of financing is so high now that distributors are taking a chance and saying, hey, economy is slowing, we'll go below what we usually hold and see where things land come January.
From an outdoor power equipment view that I cover, with the poor weather this past year and inventory, I think it'll keep having to be destocked throughout next year. I don't think they're out of the woods yet for that one. But orders have been kind of volatile this year. Is there any view, Mustafa and Karen, on order rates? Do you think things are going to finally normalize?
Can you repeat that just because it broke up? I didn't hear the last part of the question.
Your order rates have been kind of volatile and a bit noisy this past year. Do you think things will normalize next year?
Well, I think orders are going to generally be a little slower, but certainly less volatile. I think we will see them start eating into the backlog. A number of the companies said they had, quote, excess backlog. They'll start to work that down. And then you'll start to see sort of normal backlog slow a little bit. And that's going to make people nervous because incoming orders are going to be a little slower and backlog isn't going to be at record levels anymore. But there's still plenty in the backlog to support at least low single-digit growth in most of the companies. And then, of course, there's, we're talking with a negative tone here, but there are some areas that are going to be very, very strong and probably can surprise. And obviously, it's aerospace. And even though expectations are very high, they keep beating. And that, I think we still have some room to go on there. And construction's kind of a mixed bag, but I'm of the view that what's going on in the traditional construction, while it might be sloppy at the beginning of the year, the mega projects and the federal money is going to really start to build this year. And I think the rental guys in particular are going to be winners on that front. So there's, it's a year of pick your spots. And those are two areas that I actually think have a pretty favorable outlook.
Very similar to Karen. I mean, the aerospace end market has been a positive surprise throughout the year. For me, on the electrical equipment side, orders have been a positive surprise all the way up until 3Q, and in 3Q, only Eaton sort of was a positive surprise, even though America's orders slightly fell. They did say that, prior year was a very, very tough comp, and some of the orders will come in the fourth quarter. So that has been surprising positively still. But I think things will start to roll over next year. The comps are going to be very, very tough. And I think there was some anecdotal commentary again saying that, we're sort of running into capacity issues in terms of booking the orders because you're not going to be delivering those for more than a year now. So you may as well wait. And it's not necessarily our companies that are running into the capacity constraints. The large electricals they are investing in capacity. They should have the capacity for most of the products they sell. But there are issues in the supply chain that we've previously talked about in the prior calls, and we're bumping against those hurdles now.
So Karen mentioned the federal spending that's coming through next year. Mustafa, can you highlight how these mega projects are going to help the electrical equipment names? So then, Karen, maybe you can add on with any companies that also benefit in your space.
Sure. So a few companies keep a score of these, and I guess Karen could chip in with maybe Ashtead down the line. I think Eaton's figures are over $800 billion of mega projects announced since 1st of January 2021. And a mega project is a project that is over $1 billion in value. And that number has been steadily growing. It started out at around 600 billion and it's over 800 billion now. And in terms of who benefits, so pretty much all the big electrical names do benefit, but they benefit at different stages, right? So you have the big electricals who can provide a lot of the early cycle products. Down the line, you have lighting companies like Acuity, for example, and then you have some of these mega projects that are happening in manufacturing. A lot of big semiconductor plants have been announced, and they need automation, for example. And that will be at the later stages of the project. So that will be not next year probably, but 2-3 years down the line. One thing worth mentioning about large projects, some of them have got downscaled. There was a Ford battery plant which has been downscaled, for example. So overall that number has been growing, but it's worth keeping an eye out on the announcements regarding cancellations or deferrals.
Ashtead does track the mega projects pretty well. That they're the second largest rental company in the U.S. They define megas a little bit differently. It's 500 million to $1 billion, but they're saying that they have on the board or underway 700 billion. So still a very big number, and not just the absolute number, but these are multi-year projects. So things. I think we'll continue to see big numbers for a while. By my estimates, if you look at a 5 to 10 year, depending on what legislation it is, and also on the mega projects, we estimate it could add 6 percentage points of growth to the rental companies for the next 3 to 5 years. And they're already growing double digit against double digit. So, they're growing 15, 20% against a similar number a year ago. That's one area that's going to really benefit from the mega projects. And then the other area, HVAC. HVAC has been impacted by the weakness in the residential market this year, and that even though it's a small piece of a lot of these companies' exposure, it's been down a lot. So that's been an impact. And IRA has not really helped them much yet. So you're seeing a slowdown in heat pumps and a slowdown in which was a very fast growing piece of that business. The commercial side still looks really good. Next year, there is an $8,000 rebate that is cash upfront when you buy the heat pump. It's not in place yet because of the bureaucracy of getting it all, all in place. But that should happen in 2024. And the estimate for installation and equipment in a heat pump is about $16,000. So $8,000 is a lot of money. So I think on the consumer side, you'll start to see a pickup in that end of the market. And the commercial side's been pretty good. So that's another area that will benefit from IRA and some of the other components of the other bills as well, infrastructure, and there's some educational bills that they still have money left in, and so there's a lot of money across a number of projects that will help. Those are the two sectors I think that'll benefit the most.
Great. So some positive to look forward to for these companies in 24. On the flip side, Chris, I know you have a negative view on the heavy truck sector and that they might be going through a downturn next year. How will this recession be different than some in the past?
Yeah, I don't think we're looking at a recession there. I think it's pretty well understood that the heavy truck market will be down next year, especially after 3 years of above replacement level demand. We see Class 8 builds falling somewhere in the 10 to 15% range. Now, Class 8 estimates are all over the place for next year. You have some industry consultants projecting north of 25% declines. You have Packer at the other end, who's estimating down 8% at the midpoint. So very wide range. You could probably drive a Class 8 truck through there, but we're a little more optimistic than some of the industry forecasts that are out there for a couple of reasons. One, truck fundamentals are still reasonably healthy. If you look at the backlog, we're still above historical averages. The backlog to build ratio, which is a measure of new truck lead times, is generally healthy and really doesn't imply substantial production cuts in the near term. Inventory to sales has also been, somewhat in the historical target range. 2024 orders have been somewhat encouraging thus far. So fundamentally speaking, the industry's okay right now. Two, we also have pent-up demand because of all the supply chain issues over the past year plus. OEMs are unlikely to meet their production schedules for 4Q, which is going to push out, we think, somewhere in the neighborhood of 10, 15,000 units into 2024. So that should mitigate some of the downside. And then three, we see a recovery in the freight markets. We think freight markets have bottomed here. We expect both spot and contract rates to return to growth by the middle of next year. So this kind of gives us confidence that, we're not going to see a typical severe contraction in the market. Historically, what we've seen is that in the first year of a downturn, Class 8 builds fall north of 30%. So we don't think we're looking at that kind of a downturn, and think it's kind of somewhat more of a muted cycle than what we've seen historically. And on top of that, we have new emissions regulations coming in 2027 here in the US. So we think that leads to a meaningful pre-buy definitely in 2026, even potentially in 2025. And then you kind of couple an economic recovery on top of that in 2025. We think that, could drive some upside in build rates in 2025. So we think 2024 ends up being a relatively modest and short-lived downturn.
Could you give more color on those emission regulations? What exactly is going to impact the sector, and is there any downside that could happen from those?
Yeah, the downside is obviously the economy, and that that would, if we do enter a recession or a more protracted downturn, that would that obviously throws a wrench in the whole thing. The new emissions regulations in 2027, it's essentially the EPA calling for, I think, more than an 80% reduction in nitrogen oxide per brake horsepower. Um, this is probably, I would suspect, the last emissions regulation that we will see on the commercial vehicle side in the US. I think any future regulations are really going to focus on adoption of zero emission or clean vehicles. So I suspect this is probably the last one. FTR is out there with an estimate that they think it could lead to a pre-buy of somewhere in the neighborhood of 50,000 units in the year leading up to the emissions change. If you look historically, I think back in the '07 mandate, we saw a pre-buy of roughly 77,000 units. So the pre-buy is probably going to be a little bit less than what we have seen historically, and I don't think it's really going to creep up too much from there. I don't think um, the industry and OEMs in particular don't no one's really anticipating them to add additional capacity to this market. So I think we're going to be somewhat capped. And if you do get a stronger market in 2025, if you look at some of the consensus figures for GDP, we see a little bit of acceleration there. That's just going to kind of eat into the magnitude of the pre-buy, so that may diminish it. So that seems somewhat reasonable to us at this stage, but no doubt, the cost of the vehicles are going to go up, and that will drive um, some of these buying ahead of the new regulations coming in '27.
And Chris, just to put the pre-buy into perspective for us, I mean, I remember a 200,000 figure in a good year for truck sales in North America from my brief Volvo stint. That 55K relative to annual sales, I know it's a very cyclical industry, but how big is it?
So historically, if you think replacement demand, steady state, it's roughly 250,000 units in North America. And honestly, it's probably a little bit higher than that at this point. That's kind of steady state. Typically we've seen, when you have GDP growth above 2%, it typically leads to fleet expansion, and then you could get annual sales well above that. This year we're going to be, roughly 330,000 units in the North American Class 8 market. That's a very strong market. Like I said, this will be the third year above replacement demand. So that kind of, frames the magnitude of the potential pre-buy. The industry probably doesn't, I suspect the industry probably has capacity to produce somewhere in the neighborhood of 360, 375,000 units. That's absolute max, and that's not an ideal market condition with factories running, triple shifts, and it's really not good for anyone, but that's kind of the absolute cap. So I don't suspect that we will hit that number, but I certainly above 300,000 is in the cards.
Great, thank you, Chris. Karen, I know that the multis are pretty active in M&A, yet this year seemed kind of quiet. What do you think companies are going to do next year with their capital allocation?
Well, we know that um, capital M&A is actually tied to or correlated with the economic growth, and companies do tend to corporate profits is probably the biggest correlation, but you do see them pull back, just being more conservative in a slower economic environment, and also rates are up. So I think there'll still be some cautiousness around that, but there will, this year what we had was a number of strategic deals. Emerson did a very big one. Carrier did a very big one. Honeywell finally stepped out of the gate and did a deal of decent size. So we've seen those, but we've not seen a lot of, mini deals or mid-sized deals. So I think that I don't know who would be next on a strategic deal, frankly, in my group. But I do think you'll see the people like Fortive, if they can find deals, they'll do them. They have the capacity. They like to do mid-sized deals. Haven't been particularly active, but that's really about opportunities. And of course, on the rental side, you'll see both HRI and Ashted continue to do sort of small deals to strengthen their network and increase their density in big in cities. So those will be two areas, but the latter will not be big deals. So I think we'll have the one-off strategics, maybe, and some deals out of Fortive, mid-sized deals out of Fortive, and maybe one or two others, but not a real rush back to M&A. It's down a lot this year, even with the big deals. I don't think you're going to see a big bounce next year.
Great. Well, thank you so much. That's all the time we have for today. I really appreciate all your insights, and thank you everyone for listening. We hope everyone has a happy and healthy holiday season and look forward to discussing all things industrial next year.